Welcome to the Rational Edge. Today we are launching into a really crucial deep dive for anyone who runs a business or even just analyzes one. We're talking about the life cycle of a receivable.
Right.
We're going to follow that entire journey from, the moment an informal trust is made with a customer to the second that cash actually hits the bank account.
And that cycle is, it's the pulsing heart of a company's liquidity. A receivable is just a legal claim for future cash, but it's classified as one of the most liquid assets a company has.
Just one step away from being actual money.
Exactly. And if you mismanage this process, your company stalls. It doesn't matter how many sales you're making on paper.
Okay, so our mission today is pretty clear. We're going to break down the 4 essential stages companies use to manage this. That's create, evaluate, formalize, and liquidate.
And then at the end, we'll get to the key metric, the ultimate report card for how well a company is doing this whole job.
Perfect. So to set the stage, let's just quickly define the types of claims, because the difference really matters for legal strength and risk.
It absolutely does.
Most sales, I imagine, fall under accounts receivable, or AR.
The vast majority.
This is just that simple, informal credit, like a standard 30-day invoice you send to another business.
Yeah, it's all founded on trust and just standard industry practice. It's the operational backbone of B2B commerce, really.
But then you have the higher stakes situations.
Right. And that's where notes receivable, or NR, comes in. This is formal. It's usually for, bigger amounts, longer repayment times, maybe riskier clients.
And it's backed by a real legal document.
Always. A written, legally binding promissory note. And this is critical. It always carries an interest rate.
And just to be thorough, there's also other receivables, which is just the catch-all category, right?
Yeah, that's where you stick things like an expected tax refund or maybe a small loan to an employee. For this deep dive, though, we're really focused on that operational split between AR and the much stronger NR.
Okay, let's jump in. Stage 1, creation.
The birth of risk.
So a company makes a sale on credit. An AR is created, revenue gets booked, but right at that same instant, an unavoidable cost is born too.
The risk of non-payment, what we call bad debt.
It's the tax on extending credit, isn't it?
It's totally inevitable. And think about it like this. If a sales manager is celebrating $1 million in new sales, but the finance team knows from history that, say, 50,000 of that will just never show up,
then reporting the full million is basically a lie.
it's fundamentally misleading. You're overstating your assets and you're overstating your income for that period.
And that problem leads us directly into stage 2, valuation. This is where accounting tries to get real.
And it does that by following one of the most important rules in accounting, the matching principle.
Matching principle.
It's simple, really. It just demands that the expense for the bad debt has to be recorded in the exact same period that the revenue was earned.
So you can't book the sale in Q4, but wait until next year to admit some of it went bad.
You can't. And that's exactly why the simplest method, the direct write-off method, is actually terrible for financial reporting.
It's only for tax purposes or if the amounts are tiny.
Right, because the direct write-off method is pure hindsight. You literally wait until a specific customer defaults.
They go bankrupt, they disappear.
And only then do you record the loss. So if the sale was in 2023, but the default happens in 2024, your 2023 profit looks artificially high, and 2024 gets unfairly hit with an old expense. It just distorts everything.
So we need foresight, not hindsight.
Mm-hmm.
Which brings us to the better solution, the allowance method.
Yes. With this method, you proactively estimate future bad debts right away, in the same period as the sale. You use management's best informed judgment.
And how do you track that estimate?
It's housed in a really important account called the Allowance for Doubtful Accounts.
Okay.
This is a crucial device. It's a contra asset account. Its only job is to sit there on the balance sheet and directly reduce the gross amount of your accounts receivable.
So it works against the asset. And the goal is to calculate what's called the cash realizable value, or CRV.
Exactly. That's the amount you, as a business, genuinely expect to turn into cash. So if you have, say, $200,000 in gross receivables but a $10,000 allowance,
Your reported CRV is $190,000. That's the real number.
that is the real number. And it's strategically important that CRV isn't just for your internal books. It's the number investors trust. It's the number a bank looks at when they decide how much they're willing to lend you.
They'll only lend against what they think you can actually collect.
Of course, not the bigger gross number.
Okay, but let me push back on that a little. You said best guess. Doesn't that sound, a bit subjective? How do auditors stop a company from just lowballing their estimated losses to make the quarter look better?
That is an excellent question, and it's why the methodology behind the guess is so critical. The allowance has to be defensible.
And the best way to do that is,
The most defensible way is the percentage of receivables basis, specifically using what's called the aging method. This makes the estimate dynamic. It minimizes that subjectivity you're talking about.
let's break that down, the aging method. So the credit team sorts every single outstanding invoice into buckets.
Right. Based on how late they are, you'll have a bucket for current, which is maybe 1 to 30 days, then 31 to 60 days, 61 to 90, and so on.
And then you apply a different risk percentage to each bucket.
Precisely. The genius is that the percentage for the, say, 90-day plus bucket might be 20%, while the current bucket is maybe 0.5%. The older the debt, the higher the risk factor.
And that's where the strategic power comes in. Because if, let's say, a recession hits, those older, higher risk buckets, they're going to start to swell up immediately.
All right.
And that automatically forces you to record a bigger bad debt expense in that same quarter, giving everyone a timely, more accurate picture of what's happening.
It's a real-time risk indicator. It acts as an early warning system. That's the huge difference between a forward-looking approach and that reactive direct write-off method we mentioned.
Okay, that makes a ton of sense. So that covers creating and valuing the informal debt. Now let's move to stage 3, formalization. We said notes receivable, the NR, is for bigger or riskier deals. What actually makes a business decide to swap a simple invoice for a hard legal note?
It usually happens when payment terms get stretched out, beyond maybe 90 or 120 days, or when the value is just really big.
Like selling heavy machinery or something.
Exactly, or financing a big construction project. The move from AR to NR is a tactical decision. You're converting that soft trust into a hard, enforceable legal instrument.
The promissory note.
The promissory note.
And what gives it that extra legal muscle?
It guarantees 3 legal absolutes. First, a specific principal amount. Second, a definite maturity date when payment is absolutely due. And third, a specific interest rate.
And that interest is basically the revenue you earn for taking on that longer-term risk.
That's all it is. Compensation for extending credit.
We should probably touch on the math here. The formula is a classic. Principal times rate times time.
Right. And since the rate is always stated annually, that time component is where you have to be careful.
Has to be a fraction of a year.
Wow.
So for a 90-day note, it would be 90 divided by 365.
Yes. Now, you might sometimes hear about the old banker's rule, where they used 360 days.
For easier math, I assume.
Yeah, it was a holdover from when calculations were done by hand. But mathematically, dividing by 360 yields a slightly higher interest charge. The main thing for a company is just to be consistent.
Okay, so the maturity date arrives. The note is either honored, paid in full, great, or it's dishonored. If it's dishonored, what's the process? What happens then?
Well, if the borrower fails to pay, the note loses its special status as a negotiable instrument. So the company transfers the entire amount owed.
The original principal plus the interest they were supposed to get.
Correct. All of that gets moved back into the accounts receivable ledger.
Hang on. Why would you move it back to AR? Isn't the note receivable a stronger legal document? That feels like a downgrade.
It's not a legal downgrade, just an administrative one. The promissory note itself is still your best evidence in court. It's signed, it's dated, it has the rate.
So it's still powerful.
Very. But administratively, once it's past due, it functions like any other overdue debt. You put it back into the main AR collection queue to signal that, okay, now we need to escalate collection efforts using that strong evidence we have.
That makes sense. That clarifies it. Okay, on to the final stage, stage 4, liquidity. This is about the universal problem of waiting.
It really is. A company might have a huge, healthy receivables balance. It could be their biggest asset, but they need cash today.
For payroll, for debt service, to jump on a great deal for inventory.
Right. And waiting 30, 60, 90 days for customers to pay can be, well, brutal. It's just not an option sometimes. So you have to accelerate the cash flow.
And the first method for that is factoring.
Right. Factoring is the outright sale of your invoices to a specialized company called a factor. You get cash immediately, minus their fees.
But the big decision here is about who holds the risk, isn't it?
That's the key strategic choice. You can sell the debt without recourse. This is the safer option for you, the seller. The factor buys the risk, and if the customer defaults, the factor eats that loss.
But their fee is going to be higher.
Much higher, because they're covering all the collection costs and the risk.
And the other option is selling with recourse.
with recourse.
Huh.
And in that case, the selling company still holds the bag for any defaults. If the customer doesn't pay, the factor can demand their money back from you.
So the fee is lower, you get cheaper cash, but you haven't actually gotten rid of the underlying risk.
Exactly. The choice really shows a company's risk appetite. A fast-growing startup that's desperate for cash might take the lower fee with recourse deal, a big, mature, risk-averse company. They'll probably pay the higher fee to get that risk completely off their books.
It's a whole ecosystem of risk trading.
It's a massive industry, commercial finance, and sometimes the absolute worst debts, they get bundled up and sold to asset management companies for, pennies on the dollar.
Okay, let's look at the second way to get cash faster. Pledging.
Pledging is totally different because it is not a sale.
Right.
You are just using your receivables balance as collateral for a standard bank loan. The bank just puts a lien on those receivables.
So the company keeps full ownership. They still have the risk if the customer doesn't pay, and they're still the ones chasing the payment.
Mm-hmm. The bank only steps in to claim those pledged receivables if the company defaults on the loan itself.
So to recap that point, factoring is selling the asset. You get liquidity, and you might transfer the risk. Pledging is just borrowing against the asset. You get liquidity without losing control of your customer relationships.
That's the perfect summary.
So we've gone through the whole life cycle, from creating the AR to valuing it correctly, formalizing it into an NR, and then finding ways to get the cash faster. How does a CFO or an investor grade how well a company is managing all of this?
They look at one metric more than any other. It's the single most important one for this whole cycle.
And that is
The accounts receivable turnover ratio.
the turnover ratio. Okay, what's it actually measuring?
It's a measure of efficiency. It tells you how many times, on average, a company collected its entire AR balance during the year.
So a higher turnover number is better.
Much better. It means faster collections, greater efficiency, better liquidity.
And that one number really synthesizes every decision we've talked about.
It does. If management gets too loose with who they give credit to in stage 1, or if the collection department is failing in stage 4, that turnover ratio will drop. And a declining ratio is a huge red flag for investors and lenders.
It's the ultimate feedback loop.
It really is.
Okay, let's do a quick but full recap of everything we've covered in this deep dive.
Let's do it.
We started by defining the difference between the informal trust-based accounts receivable and the formal, legally stronger notes receivable.
Then we established why the allowance method, using that contra asset account, and the dynamic aging method is so essential for accurate forward-looking valuation.
And for following the matching principle, we then detailed the nuts and bolts of notes receivable, that principal times rate times time formula, and what happens administratively when they're dishonored.
And finally, we contrasted the two ways to get cash faster. Factoring, which is a sale of the asset and the risk.
Versus pledging, which is just using the asset as collateral for a loan,
Mm-hmm.
and it all culminates in that final report card.
The accounts receivable turnover ratio, the ultimate test of collection efficiency.
A really comprehensive journey.
And here's a final sort of provocative thought on that turnover ratio. Context is everything.
Meaning a high ratio isn't always the only goal.
Exactly. Think about a local utility company. They get tons of small monthly payments, very reliable. Their turnover will naturally be very, very high. Now, compare that to a custom home builder. They might issue 3 massive invoices a year that take months to close. The ratio is going to look much lower, but are they less efficient?
No, it's just a totally different business model.
Right. So efficiency always has to be judged relative to the industry and the specific business, not just against some arbitrary high number.
That's a fantastic point to end on. Context is key.
Yeah.
Thank you for listening. See you next time.